Have you ever found yourself just staring at a stock chart, watching the price bounce all over the place, and just wishing you had some way to make sense of all that chaos? Well, if that sounds familiar, you are in exactly the right place. Today, we're going to pull back the curtain on one of the most popular tools for doing just that, Bollinger Bands. Let's dive in. I mean, really think about that for a second. A market can be super calm one minute and then totally wild and volatile the next. So, how do you actually measure that? How can you tell if a price is statistically high or maybe statistically low? It's a massive challenge for pretty much anyone trying to navigate the financial markets. Well, the answer, or at least a really powerful piece of the puzzle, comes from this tool right here. It was developed by the technical analyst John Bollinger way back in the 1980s. And these bands, they're designed to do that exact job, measure volatility and give us some solid clues about whether an asset might be overbought or oversold.
Okay, so to really get how to use these things, we first have to pop the hood and see how they're actually put together. And believe it or not, it all comes down to just 3 lines on a chart.
All right, here's the magic. I want you to picture a river. The middle band is like the main current. That's just the average price over a certain amount of time, usually 20 days. Now, the upper and lower bands, those are the river banks. And they're drawn a specific distance away from that middle line using a statistical thing called standard deviation, which is just a fancy way of measuring how spread out the prices are. So these river banks get wider when the market's choppy and they get tighter when it's calm. It creates this awesome dynamic channel that the price flows within.
And that specific distance, 2 standard deviations, that's really the secret sauce. Because statistically speaking, that channel is going to contain about 95% of all the recent price action. Just let that sink in. It gives us a really clear defined range of what's normal for the price. So by definition, any move that breaks outside of that 95% channel is an outlier. And for traders, outliers are signals to pay very, very close attention.
So we've got our 3 lines, we've got our 95% channel, but what does it all mean? How do we actually read what these bands are trying to tell us? Let's get into decoding the signals.
Okay, the first signal is just how wide the bands are. When they start to widen out, it means volatility is high. The market's got a lot of energy. But the signal a lot of traders really wait for is the opposite, something called the squeeze. This is when the bands get super narrow, like a coiled spring. It tells you there's low volatility, things are quiet, which is often the calm before a huge price breakout. The squeeze doesn't tell you which way it's going to go, but it's screaming that a big move is probably on the horizon.
The second big signal is where the price is inside the bands. So when the price touches that upper band, it's considered statistically high, or what we call overbought. And when it touches the lower band, it's statistically low, or oversold. This whole idea is based on a concept called mean reversion, which is just the theory that prices, after making a big move, tend to snap back toward their average. The bands basically give us a visual map of where those extremes are.
All right, so we know how the bands are made and what their movements are telling us. So the big question is, how do traders actually use all this information to make decisions? Let's check out a few of the most common strategies. Let's try to put this all together. So when traders see a squeeze, they get ready for that big breakout. When the price hits one of the outer bands, it's a signal to maybe think about taking profits, or maybe even opening a new trade betting against that recent move. And in a market that's just kind of going sideways, traders love what's called the Bollinger Bounce. They might buy at the lower band and sell at the upper band, basically treating the bands like bumpers on a pinball machine. This quote right here really nails the whole idea behind the tool. Because the price stays inside those bands about 95% of the time, the bands give us this dynamic frame of reference for what's statistically normal, or extreme, for that specific asset at that specific time. Now, this next part is super, super important. As powerful as Bollinger Bands are, they are absolutely not a crystal ball. They've got some major limitations that you have to understand if you want to use them well and avoid some really common mistakes. So here are the big ones. First, they are a lagging indicator. They're telling you about what's already happened, not what's going to happen. It's like driving by looking in the rearview mirror. Second, they can totally give you false signals, especially when the market is really choppy. Third, those standard settings, they're not a one-size-fits-all solution. And finally, in a really strong trend, the price can just walk the band. It'll just hug that upper or lower edge for a long, long time, which can be a huge trap for traders. Trust me, relying on this tool alone is a recipe for disaster. And that brings us to maybe the most important rule of all. Bollinger Bands are a confirmation tool, not a standalone system.
You should always use them with other indicators. For example, if the price hits the upper Bollinger Band and another tool like the RSI is also screaming overbought, well, your case for reversal just got a whole lot stronger. Never ever trade on just one indicator. Confirmation is everything.
So what have we learned? Bollinger Bands give us this brilliant way to understand volatility and spot statistical extremes. They tell us about probability, not certainty. They help you read the market's current mood, but they're not going to tell you its next thought. The real skill is in combining this amazing tool with others to build a more complete picture of what just might happen next.